Hey everybody, thank you for joining us. I'm Darren with Top Key. We have a really good panel lined up for you today on financial strategies for vacation rental managers. We hear a lot from property managers about how their just whole financial operations are just increasingly complex. You're juggling bookkeeping, trust accounting, P&L, owner statements, expenses, and that's kind of just the tip of the iceberg. So our goal here is to just bring together people that really know what they're talking about, bring together the experts to make your life a little bit easier, make you a little bit more profitable. As a reminder, this is just an interactive panel, so drop any kind of questions that you have in the chat throughout the panel. You can switch between just sending it to the host and panelists, or you could send it to everybody if you want to chat just overall in the panel. It makes it for usually good discussions among people. So yeah, with that in mind, I want to introduce the three panelists that we have today, and then I'll pass it over to them. But we have Jacobie Olin, president, C2G Advisors. He's expert on vacation rental M&A, maybe the expert on it. Ben Coons, owner at Keystone Bookkeepers. He's going to bring his expertise around bookkeeping and accounting for vacation rental managers. And then we have Top Key's CEO and founder, John Sukhia, who's bringing expertise on how property managers use technology to streamline financial operations. So yeah, maybe to kick things off, if you guys want to introduce yourself.
Sure. Thanks. I'm
Jacobie, let's
happy
start with
to
you.
take the lead. Yes, I'm Jacobie Olin, the president of C2G Advisors. We're a M&A and consulting firm that specializes in the short-term vacation rental industry. We primarily do represent sellers of vacation rental businesses. We do about 20 transactions a year for about 100 million in total deal value, and really mostly work with companies that are in your traditional leisure destinations, your beach, your ski, your mountain, those types of areas. But yeah, I love the industry. I mean, I was born and raised in this crazy pirate industry, and very bullish on the next 5 to 10 years.
Awesome. I'm happy to go next. I'm John Sakai. I'm CEO, co-founder of Top Key. Top Key is a financial operating system for vacation rental managers. We really focus on helping managers close their books faster and recoup more money. We do that through a number of different products, but ultimately you can think of us as a system to really support and help streamline your bookkeeping and finances and close books much faster. And we're working to integrate with a lot of great partners and great PMS and accounting systems. So our focus is solely finance and operations on that side of the table. So.
All right. I'm Ben Coons, the owner of Keystone Bookkeepers. So we provide bookkeeping, owner reports, and trust accounting to short-term rental property managers and investors. So we work with property managers who are traditional property managers, co-hosts, arbitrage models. We serve managers anywhere from 1 to 100 plus listings. We manage about 1,200 listings on a monthly basis. We started out kind of doing the books for one short-term rental client a few years ago, and then over the past 3 years have evolved to focus, primarily on this industry and help those property managers scale and grow in a profitable manner.
Awesome. Cool. So maybe to kick us off, everyone's bringing a different perspective, different expertise here. What would you say are the top financial challenges that vacation rental managers are facing right now, based on what you hear, what you see, what you're working with people on? Ben, you want to kick us off here? Or
Happy to.
Go ahead, Jacoby.
Oh, sorry. Okay. Yeah. Sorry about that. Yeah. So we do around 50 valuations a year on companies as small as 20 properties under management, really up to like 2,000 properties under management, and everywhere in between. So we honestly, it's funny, we see a lot of similar challenges amongst that entire spectrum of managers. And I think just taking a step back, like just where we are in this cycle, I think is a big problem as to why property managers are having facing some financial challenges. And what I mean by that is really from second half of 2020 to first half of 2022, we were in this just gangbusters, COVID froth, revenues were going through the roof. You could put any price out there and it was getting booked. And property managers were having the best 2 years of their entire career. And that was awesome. That was fantastic. But what that led to was a little bit less focus and understanding of expenses, of expense management of your company. And then call it second half of 22, really all the way to today, the revenues have been steadily decreasing on a per property basis, but the costs have continued to either increase or be at a similar spot. And that's from human capital, so your staff, which is generally the largest expense in your business, to software vendors, to goods and services. And I think a lot of managers kind of got caught with their pants down because they looked back a year later. It may have been a little bit too late in that, and they have bloated expenses with revenues kind of remaining steady or decreasing. And so and we've seen that same story over the last 12 to 18 months. And so I think managers kind of weren't prepared for that. And I think things they can do or should start doing is really starting to take a focus on budgeting each month and then running your actuals versus that budget and looking at each expense line item and understanding kind of where things are out of whack.
Yeah, I would just say jumping in, I mean, consistent with what Jacobie says, I think what we see is kind of a combination of things. So it's the economy and the market having shifted off these huge highs, right? That were just kind of unprecedented in our space. And then kind of complementing that is just the complexity that folks have to deal with in general around expense management and also just, attribution across purchases, across AP, and then ultimately getting everything back to trust and to kind of the regular course work that has to be done. And that always creates additional complexity. So typically what I've heard, and I think is probably true from, I think a lot of people have mentioned this to us, is that, there's just kind of this constant, there's pressure from the top and there's pressure from the economy and there's pressure from our kind of comps having shifted. Although it does seem like we're maybe moving a little bit past that, which is encouraging. It seems like we've kind of maybe hit some lows and we're starting to see an uptick, at least in some markets. I heard over the last weekend when I was in Vermont talking to folks. So it's that coupled with just a general lack of or a sense of not having a good handle or grasp of what is being outlaid, and knowing so much that can be outlaid, that is outlaid could be ultimately tracked back to properties and ultimately reimbursed if done correctly. So, these two things create kind of added friction, and ultimately I think that just creates more tension and more frustration. And often it's just like, I just don't know what I don't know, and I think that to me is, and I think any business owner can resonate with that, but our industry just has such a unique use case because of the trust on the operating and or just the focus on, basically doing a bunch of different P&Ls every month for all these different properties. And, obviously Ben, can speak more to that just based on having kind of seen that on his end operationally doing it so much, but yeah.
Yeah, I think that environment just really means people need to kind of buckle down and focus on their financial operations. It's more important to look at that, as Jacobie said, look at a budget, look at your P&L, really looking at it on a per property basis. So you can look at your commission, you can look at your cleaning margin, you can look at your technology margin, your damage waiver margin, and kind of see how profitable or if they are profitable at all. Also on your financial operations, it's more important to retain those owners and those properties that are profitable, because it might be harder to go out and get those new properties because there's more competition in the market. There's more people doing this. So the speed of owner reports, of being able to kind of consistently get those out accurately, get those paid out, becomes more important, and there's more pressure on that than there was when, everyone was doing well.
Yeah, and so yeah, to kind of build on that, so Jacoby, you were talking about revenue decreasing for property, costs increasing. Ben, you were just talking about it too, with profitability, and how should people be thinking about managing their P&L, budgeting? I mean, why is it important? So, we're not in a world where, like Jacoby was saying, the COVID froth. So yeah, how should people be thinking about their P&L and best practices there?
Yeah, I can start on that. You guys can follow. So I mean, when we look at budgeting, we have to start from a revenue perspective and a booking perspective, and then everything kind of flows from there, at least on the revenue side. Especially important if you're in like a seasonal vacation market, because you can't really just divide out, your income or expenses over the 12 months. You have to adjust for that seasonality. So again, starting at your booking revenue, working your way down through commission, becomes really important. Being able to forecast out, what your vendor expenses are going to be, what your contractor expenses, and what your software expenses are going to be. And again, being able to separate out those expenses on your P&L so you can look at what you're collecting on cleaning revenue versus your expense, what you're collecting in your tech fee versus your software expense, and make sure you're, staying profitable on a per kind of service basis and not just overall is really important.
Yeah, and I would, I think that's great, and I would just add to like really starting with your chart of accounts and really the construction of your financial statement. We see, I mean, every property manager's P&L that we look at is different from the last one, and it ranges all over the spectrum. So I mean, we've seen property managers where they have one line item for all their revenue. It's just revenue. So either having a specialized bookkeeping firm that does work in this industry that can help you with your chart of accounts, or if you have a generalized bookkeeping firm, try to make sure they've done some work in this industry before. But making sure at the top, having all of your various revenue line items split out, and then so your commissions, your booking fees, your cleaning fees, stuff of that nature, and then actually having a section below it that are the cost of those revenues, your COGS. We still see probably 50% of companies in this industry do not even have a COGS section. So making sure you then have the direct cost of those various revenue line items there. And then you would then have, call it a gross profit from that. And then you would have your operating expenses below that line and getting to your net income. And really, if you don't even have it constructed that way, then you're not going to kind of be able to benchmark yourself versus your peers, what margins in the industry there are, because you're looking at apples and oranges. But so like, I would say starting there, creating a standardized chart of accounts, and then start tracking individual margins. And as your company grows, you can put people on your team to be accountable for those specific line items or divisions within your company.
I have a quick question kind of following up more for Ben, but just curious, like, I think a lot of times what's so frustrating or challenging about this for a lot of folks is just, you're never starting from a clean sheet. There's always existing books and there's always existing processes that are in play. And it's just adds complexity to kind of start ripping that stuff out. So, very tactically, and maybe I'm sure this varies by company that you might work with, but what would be, if you were kind of advising someone, what would be maybe a very easy first step to take, knowing, let's say you have 80, 90, 100 units, you've been in business for a few years, you've already been doing this stuff for years in terms of reporting. Like, what would be maybe one or two things you could do kind of immediately to get a handle versus just kind of starting from, I just have all this stuff that ideally I could do, but that can often take, I'm sure, could take months to kind of get all that stuff to the point where you feel really good about stuff. So I don't know if there's a couple things that come to mind, Ben, or maybe the things that you would be doing right when you start that might. be helpful for folks who are just trying to take a stab at making
Yeah, and I
progress.
think it kind of goes to Jacobie's point of breaking out those revenue sections is really important. The other thing is getting the booking revenue out of your revenue. So that should be kind of on your balance sheet, because that honestly is kind of noise. So you really want your P&L, your income section, to just be the income for your management company. So kind of isolating the actual revenue, so your commission revenue, your cleaning revenue, your tech fee, pet fee, early check-ins, kind of isolating those and being able to map them to individual lines is very important. You can do that, manually using your PMS. There's other softwares that will help with that, but being able to see those, and again, getting that booking revenue out of there. We see a lot of people that come in that have the booking revenue kind of, as Jacobie said, kind of one line, all revenue coming into the company. And it's really hard to kind of get to a profitability number with that being in there.
And Ben, I bet that's even more fun and crazy for you all, because you all have some lease arbitrage clients where like the booking revenue then is actually accounted
Yep.
for revenue.
Yeah, and then we have then there's the co-host where the revenue actually never even came to the property manager in general, because it went to the owner, and then you're turning around and billing that owner. So you definitely don't want that to be in your income and your revenue, because you never even receive that cash. So even within the space, all these different models can lead to like a different P&L structure.
Yeah, we have a question from the audience here too, kind of following up on as you guys were saying. So, a question from Steph here: is there a general labor percentage range for our industry that we want to stay within?
Yeah, I'm happy to take that. So, if you're doing it as a percentage of revenue, and revenue being the revenue on your P&L after the homeowners have been paid out, so not the homeowner portion. Generally, we see companies want to be between 20 and 25% their payroll. That does not include cleaners, as the majority of companies use cleaners as contractors. If you do have cleaners in-house as W-2, then we see closer to 40%. So if your company brings in $1 million of revenue, then you could expect to have payroll of 250 grand.
Got it. Okay. And another question here that's kind of related: what range would be a net profit percentage across the industry? So I think asking for benchmarks here. Would be really curious on that.
Yeah, so similar there. Generally between 20 and 30% of revenue is net income, would be your profit. So once again, in that scenario, if you brought in $1 million of revenue, you should strive to kind of make 200 or 300 grand of profit. If you're significantly above that, then likely you're payroll short, or if you're significantly below that, then that's something I would dig in and understand. You may be payroll heavy, you may be losing money on cleans. There could be some expense creep that needs to be managed.
How could this is a topic that we had on the agenda here, which flows in perfectly to these audience questions. And for people that are dropping in questions, we'll try to get to all of these throughout this. But what can people do to improve profitability? So if they're thinking about, okay, maybe I'm not up to that 20 to 30% you just mentioned. What can they do on both to improve cash flow, but then just overall profitability? Are you guys thinking about that?
Yeah, man.
Go ahead.
Yeah, I mean, one thing that we see is just really getting a better handle on expenses is something I think, if you think about expenses and kind of leakage at a property level, ultimately it flows to your margin, right? And so you think of increasing revenue, but you also think of the margin that can be unlocked by just reducing the expense side. So getting a better handle on how things are flowing and how data is basically working its way to the respective owner statement or the P&L in that case, I think can be really valuable. And that's something selfishly we do a very good job of, but ultimately that can help reduce some of the pressures you might be seeing from a profitability standpoint. And I don't think folks always think about it that way, but like revenue and expenses, there's two levers there. So, certainly getting a handle on the expense side can help your margin, and that can certainly help as you think about kind of like long-term selling the business, what folks are looking at.
Yeah,
Yeah.
Oh, go ahead, Ben.
All right. So on the expense side, to kind of piggyback off that, making sure that you are charging those reimbursable expenses back to your owners. That's something we've also seen when we take over is we really implement kind of a rigorous process to make sure that those expenses are going to owners. And some people might not realize that they were, eating some of those expenses. But also kind of looking at the revenue side, making sure you're kind of staying within market for what you're charging and charging what you're worth, to be honest. We get some people come in that aren't charging a tech fee, for instance. And so that we typically see between like $100 and $150 per month per property to kind of cover some of that technology, to cover maybe your bookkeeping, to cover the months when an owner is staying there and you have to keep paying for these expenses anyway. You want to make sure you're charging, commission probably somewhere between 20 and 25%. Again, is typically what we see. And then there's some other things you can do to move the lever. You can upcharge on some of the billable expenses. If you're making a margin on cleaning, you can keep that in-house. And some other kind of little levers to move on that end as well.
Yeah, I'll say one thing on that, Ben. We spend a lot of time with property managers and talk to them about the tech fee is a really smart thing to do. And I think what some people kind of bristle at as managers is just not wanting to introduce something like that. But there's nothing stopping you from when you sign a new homeowner adding that as a potential. And you might have something where you have some owners that are paying it and some that aren't. But ultimately, like when you close a new owner and you are kind of moving forward, they're taking this very important asset and you're now taking over that asset for them. Introducing a small modest fee that is in that agreement can, I think it's very, very defensible from a manager's perspective. And I would just encourage everyone not to be afraid to ask. I think managers sometimes get worried about nickel and diming folks. And I think you just got to be clear about what the fees are for and have that process. If it's you or if it's someone on your sales team, being able to convey why that's important and kind of show what the value is for your business. People respect it. And a lot of times I found owners are much more receptive when they understand kind of why. So it's just something that you might need to do kind of in bits and pieces, or maybe when you do renewals. But being clear about it and having a process, maybe write a one-page or doc that summarizes, hey, we charge a couple different fees. Here's why we're better than the other folks maybe aren't doing that. You might think, X, Y, Z, but having that like as a bit of a practice with your business can really be valuable. And once you do it, it becomes part of your pitch. It actually becomes a value add.
Yeah, we coach people on that too during our onboarding process and help them kind of build that argument if they don't have one. And kind of, again, help the owners understand the value that they're bringing to the table and why something like that's really necessary.
A quick question here.
I would just.
Oh yeah, go ahead, Jacobie.
Okay, I'll go quick. Just to piggyback on what John was saying at the beginning, profitability it's just a simple formula. It's revenue minus COGS minus expenses. So you have those three levers that you can increase revenues, you can decrease COGS, you can decrease expenses. And you don't solely have to focus on one. All of those can be done in tandem at the same time. And once again, going back to the budgeting is really tracking every month what your actuals were versus the budget. And then what is also important there for like cash flow and profitability is find out what your major margins are today, how that stacks up versus your peers. And then there are some other ones that are like non P&L focused, but like employees per bedroom that your company has or employees per home. You can look at what your revenue per employee is. You can look at some of these. So as you're growing, you can make these database decisions on, is it time to hire that new employee? Right now I'm at 10 homes per employee. How can I add one or two more homes? And when do I need to do that next hiring? Which I think is paramount. And then on the revenue side, the take rate is something in this industry that I think is super important, because that's essentially what the guest pays at booking, how much of that dollar amount is going to your P&L. And generally we see around 35 to 45% is the take rate around the country. And so that'll be your commissions on the rental, and then the additional kind of ancillary fees you're charging. And one thing to look at that is really spend a 2-3 hour process once a year, and you can create a spreadsheet that compares what your current take is on different bookings in different seasons, and then compare to your top 2 or 3 competitors either in your market or in the region. And you can do a little secret shopping, go do some bookings on their website, see kind of what fees they charge, whether they're static or dynamic, whether they're on a per night or a percentage basis. And then you can see kind of where you play versus them. And that can really, one, help you with your communication to new homeowners or to your current homeowners. Or you may find something super interesting out, like, oh, wow, the market charges an 8% booking fee and I charge a 2%. So then, like, wow, now that I know this information, I can either move it up to market, I can move it up a little bit, or I can keep it the same and kind of use that as a selling point for homeowners.
Yeah, I've seen folks charge, wildly different linen replenishment fees, for example. I mean, you'll see, and these are just things that you can pass back to the owner a lot of times. But again, it depends on the market, it depends on the quality of maybe the size of the how high end the properties are. But I've seen advertising marketing fees, I've seen maintenance program fees that are just kind of set, like kind of what we're talking about, tech fees, of course. And then in-house maintenance, having kind of like a fixed fee versus a variable fee. I assume there's probably some best practices in market. Certain markets are just going to be more or less receptive to that type of stuff, depending on what your competitors do. But it varies wildly, and we've seen it very differently depending. Even right down the road, someone's charging X dollars and someone's charging Y dollars for the same service. So.
Jacobie, earlier you were talking about just the kind of 20 to 30%, the profit margins. Clarification question from the audience. So was that revenue, so when you're calculating that, is it from gross rentals or starting from commissions on down? How are you doing that formula?
Yeah, so that's based on your profit and loss revenue, which is commissions plus gross ancillary fees. So that would be booking fees, cleaning fees, limited damage waiver, any homeowner charges. That is not a percentage based on the actual booking, though.
Cool. All right. Yeah, thanks for clarifying. Yeah, so maybe kind of a topic you guys have all touched on a little bit. So another one from the audience, but I think this is pretty relevant overall. Aside from financial reports, what are the ideal KPIs for a bookkeeper to communicate to the property manager? So slightly different angle on this, but maybe Ben, you want to take this one?
Sure. It's something we've been kind of working internally to try to build out a little bit more and talking to our clients about what's really important. We do look at some of the like percentage of revenue metrics. So like what's your software spend as a percentage of revenue? What's your like contract labor, which typically involves could involve like an operations person, typically involves like your guest communications team, looking at that as a percentage of revenue. And then looking at the gross margin percentage. Again, typically what we look at, it does vary wildly because we do kind of work with, say we work with probably the smaller end of like where Jacobie sees. So people as they scale, you kind of have those peaks and valleys where you bring someone on and then your profitability goes down. But some of that kind of goes to forecasting and kind of looking at your run rate and knowing, that you've got a sales pipeline coming in that's going to kind of bring you back up to where you want to be on the profitability end. But again, definitely on the like kind of percentage of items and looking at revenue.
All right. Maybe switching gears to trust accounting, big topic. I know we had this one on the agenda because we know this is a big one for everyone. And then we've also had people in the audience pinging us with questions about trust accounting. So yeah, how should people be thinking about doing trust accounting? What should they be doing? What are best practices? Maybe what are mistakes people make? Yeah, what are your thoughts there?
Yeah, I mean, we see a lot of folks that just need to be separating those accounts as a starting point. I do a training deck that I often feel a little weird about even mentioning that, but I realize that many people don't do that. So, making sure you have separate and distinct bank accounts for trust and operating and having those set up. In many places, it's legally required. So you just need to have that and making sure those are FDIC insured accounts that you're segregating the funds in. And then typically it's using a proper trust accounting system, be that PMS or working with someone like Ben and kind of in collaboration with your PMS to have that system of record in place to be able to effectively adjudicate expenses and be clear about like where the funds are flowing. And I think the last thing is just having a really good system to be able to track and push transactions and input back and forth. So doing that kind of in a very, as much of an automated way as possible. There's probably a number of other things that I think can probably help improve as well. Maybe Ben, I don't know if you guys want to take a stab at this, but those are some high level things that I see just kind of kick things off.
Yeah, I'd say there's like a perfect world and a practical world. In a perfect world, all the booking revenue flows into the trust account, and then the money out either goes to the operating account, the management company to reimburse them for expenses and commission and cleaning, or it goes to the owners to pay them out. Again, that's the perfect world. We don't often see that, especially as they're growing. That can become a kind of a cash flow crunch. And if you're only doing that like once a month when you reconcile, that's tough. So that's why it's kind of, very important to work with a system that tracks, what's being spent. Using a credit card is a great tool there because you can put everything on there. You put all the expenses on there. You can reimburse your operating account from the trust account for those expenses and then pay them off out of your operating account to kind of keep the flow of funds as kosher as possible. But again, people pay stuff out of the trust account that might be a management expense. We track all that. And so, if you're working with a bookkeeper or if you're doing it yourself, you want to make sure you're tracking like what type of expense is coming out of your trust account. Is that a management expense or is that a like owner or reimbursable expense? Again, ideally nothing's coming out of there, but we don't live in the perfect world.
I think from an M&A perspective, at least, it's crazy. I mean, it's obviously trust is not required in every state and really in a lot of states. But from an M&A perspective, one is going to make you look unprofessional if you're underfunded, if your trust account is underfunded for monthly bookings and for advanced. And so in reality, I mean, we've had deals where, let's say the purchase price was $1 million, but the trust was underfunded by 150,000. Kind of that gives the buyer three opportunities there. And one, they could just lower the purchase price commensurate, and then they're kind of paying $850K for the business. Two, some of them will retrade even further because of the unprofessionalism and say, hey, we don't like where it's at today. Like, we're going to change the price from $1 million to $750K. Or three, like, we've seen buyers walk at that point and not want to be a part of that, or kind of save the business there. And some of these processes, they take 4 to 6 months. So it's a pretty emotional process. And if we're 3 months in or something of that nature, and a deal falls apart because of an underfunded trust, like, that's super tough for sellers. So definitely something to keep your eyes on. I know it's tempting, especially in slow season, as like a line of credit, but as much as you can not dip into that, the definitely helps from an M&A perspective.
Yeah, that's definitely one of the first things we do when we like the first month of onboarding is we will kind of balance that trust account and let them know under or overfunded. Oftentimes it's a nice surprise and it's overfunded because a lot of property managers, if they aren't tracking it, they're nervous about pulling out and they're kind of running everything bare bones and leaving too much in the trust account. And so sometimes we get to be the bearer of good news, which is great. Um, but really, when you're looking at your trust reconciliation, we look at it as three kind of big buckets that you want to make sure you're accounting for at the end of each month. The first is any future deposits, future booking deposits. So typically, if you're booking through Stripe or something like that, you're going to get 50% deposit up front. So making sure you hold all those funds separate, your payouts to the owner for the most recent month, and then any rental taxes or vacation rental taxes you're collecting. Those are kind of the three big things we look at, that we make sure these are all there in the trust account. What's left is the amount that gets transferred to the operating account, to make sure you're covering all your future liabilities.
One other note there on the overfunded accounts, there are a lot of states that allow you to earn interest in those deposit accounts. You just have to disclose it to your owner, and in some states you don't. But it's the law and the case law and the rules in different states vary wildly. But for the most part, it's very different from long-term rental broker holdings like that have very strict kind of standards. Now that's good and bad, right? Because a lot of people don't realize that they actually could be taking advantage of that. And banks typically aren't going to be, oftentimes, if you even tell them you're doing this, they'll just go, okay, well, here's a deposit account, 0 interest bearing, et cetera. So, I mean, the average company we have seen have, you might have 150 units. You may be sitting in the high season with, $2-3 million in that account. And, when rates are at 0, that's not a big deal, but, there's really yield that you can unlock. So if it's talking to your bank, if it's talking to your partner banker, or looking at a company like us, like you can earn interest. There's some things you need to disclose, and often you can kind of include that in your contracts. But it's just something to note that a lot of people don't realize. And if you can make 3.5-4% on those deposits, it's certainly worth exploring. Again, talk to your accountant, talk to your lawyer. This is not legal advice, and it varies. But it does make a difference, and I think a lot of folks can take advantage if they're eligible for that in their state. And again, the financial institution you're working with is probably not going to preemptively give you that option unless they're you're encouraging them to.
Yeah, it's well said. It's similar to the insurance industry. Like, that's the float. You're making interest on the float. It's Warren Buffett's favorite business model there. So yeah, I second that for sure.
Kind of a follow-on question to that, another one from the audience. What's the ideal banking system for property managers? John, this might be a good one for you.
Yeah, I mean, I think the thing that comes up a lot is, I would say, well, maybe three key things. One is just trust and security. So a system that is FDIC insured. We recommend working with a bank that offers sweep accounts because it allows you to earn incremental FDIC insurance above that $250,000 threshold. So, a sweep is essentially you can think of it like a generator network. You have one generator in a city. A sweep account, it essentially kind of distributes funds on the back end to multiple sub accounts that are overseen by different banks. And so it gives you the ability to just earn higher FDIC insurance. Very, very important when you're holding owner funds. As we've seen, there have been banks that have had pressure. Regional banks have had pressure. We've certainly seen it with rising rates and pressure from the commercial mortgages and whatnot, different markets. So that's one thing. The second thing is just really mitigating fees and having a system and a bank partner that's not charging you a lot of fees. I was talking to a manager in LA a couple of weeks ago, 85 plus high-end homes and about $2,500 a month in fees. Why is this an issue? Well, a lot of people that run property management businesses make an inordinate amount of ACH payouts. You're doing owner payouts, you're paying vendors. It's a very different model from an average SMB company. So, a lot of banks that essentially kind of will pass back some of those costs. So finding folks who, generally speaking, aren't going to charge you, kind of ticky-tack fees, that's really important. And then, the ability to create multiple deposit accounts and then maximize kind of yield and or these other pieces we just talked about. So, I think having a system that is, and then one other thing, which, I think is really clear when you start working with more tech forward banks, is just like having nice technology. I mean, how many times have you worked with your bank and just been like banging your head against the keyboard trying to deal with stupid things that banks are built off of, like something called COBOL. I think it's like a coding language from the 60s. And, it's really, really old. It's really, really slow. And a lot of regional and kind of even national banks just have really poor UX technology products. So those are all things that kind of come to mind. I mean, there's plenty more, but obviously number one and first and foremost is trust and finding, good security and having good partners on that side. And then maximizing yield and minimizing fees, and then good technology. So kind of sum that up.
Dan, I saw you nodding your head. It sounds like you're probably you see this firsthand on the accounting side.
Yeah, I was going to piggyback off that with some of these are just harder to work with in general. Some of them don't even connect to QuickBooks, and so we're forced to like manually download Excel files and upload them to QuickBooks. Getting, on the security side, some of these like smaller banks, the regionals, the credit unions, you can't add another user. So if you want to add your bookkeeper, add someone else on your team, you got to share your login credentials, which obviously is not the ideal situation. Ideally, you can set them up with a new username. You can make it read only, so you can just go in and view transactions, download bank statements, connect to apps. Even some of the bigger banks, look at you, Bank of America, make it very difficult to kind of work with a third party, even if you've got a business account. There are some that are way more friendly than others. And so kind of thinking about that, I know it's tough to change banks, but it can, so kind of a one-time pain to like make your life a lot easier in the future.
Yeah, Ben, just piggybacking on, I have a few more things that just came up in my head. One is, having the ability to have multiple instances in one system. So having multiple banks and being able to toggle, very hard to do in some banks. Wells Fargo is like this. I know Bank of America. It's not that hard to do that, but for whatever reason, banks make this really complicated, and you need separation, but the ability to then toggle as a user. You do not want to have sharing logins. That is a complete no-no in technology, and having your login for your financial institution shared with a third-party bookkeeper. I've seen this plenty of times where it's like, oh, here's the password. People are texting this stuff out. That's just so bad from a security perspective. The other thing I would mention is integrations, right? Your bank should be able to talk to your PMS. It should be able to talk to your accounting system. So, like Ben said, the other thing is your bank should be, or your partner should have the ability to do bulk owner payouts. Something that a lot of managers struggle with, even in these PMS systems, is just being able to do payouts from the trust or wherever you're doing that to either vendors or owners. And so having systems that make what we found is we kind of go in and we start working with people, and then it's like, a lot of the owners of the businesses aren't necessarily in the weeds here, right? And so you're paying a bookkeeper, you're paying an accounting person in-house typically. And then they're like spending all this time on this type of stuff. And you're going like, oh wow, you didn't know that that's what they're spending their time on. I go into Wells Fargo, I have 40 properties. I have to pay individually each one, press a button. There's risk that you're going to hard code fat finger. There's risk you're going to make mistakes. And there's risk that you're just spending a lot of time on something that can be automated. So, just very simple things that maybe not come up. Like, I don't want to sell Topkey too much, but you can plug into your PMS, pull out all the bank payment data, depending on the PMS you're working with, and then essentially just press a button and do bulk payouts directly to those owners. So, there's ways you can kind of mitigate some of this stuff, but yeah.
Yeah, this kind of ties into a few questions that we're getting from the audience around systems, tooling, this kind of thing. So, what banking we recommend, accounting systems. There was someone that asked, they've got multiple business models, so long-term rentals, short-term flips. Is one accounting system good? So I think people in general are curious about just like what should their systems actually look like, and then Jacobie, I think you can provide insight on what that actually means for them down the line too. But yeah, Ben, I'd be curious. What do you think on the system side?
Sure. We always, I mean, typically we're not going to make the client change the PMS. Most PMS at this point are able to kind of work with a lot of systems. So for us, the kind of base is the ledger. And so we use QuickBooks Online for that. Some people come to us with Stessa or with an Excel spreadsheet, or trying to do it in their PMS or things like that. Having QuickBooks Online, being able to bring in those bank feeds, being able to reconcile bank statements and credit card statements is incredibly important to verify that you've got all the transactions flowing in there. And then from there, you can kind of build on top of that with kind of a best-in-class tech stack. Whether that's an expense management like Topkey, whether that's like an owner statement type system like VR platform or clearing or things like that. But having kind of a base general ledger where you can have a P&L, you can have a balance sheet that foots and ties and reconciles is really important to kind of build off from.
I would say QuickBooks is fine for 98% of companies in this industry.
Yeah. Sometimes one thing we see is a lot of people with QuickBooks in particular, if they're going to use a system like QuickBooks for this, they'll use classes as a general designation for property. And so something we do that's helpful for people is you can tie a property in Topkey to a class in QuickBooks. And then when you sync expenses over, it automatically will populate there. Super helpful. And again, kind of just reduces that manual work that has to be done on the back end. So making sure that, you can do that in whatever expense system you're using. And yeah, I agree with what Ben and Jacobie said. Just generally that stuff tends to, these little incremental things that you might not realize add a lot of time to your team or your own workflows is something that I'm passionate about trying to reduce.
Yeah, and if you've got classes set up in QuickBooks, which is the way we do it, you're able to run that P&L by class. And so that starts to get into, being able to analyze your business on a per property basis. So you can look at, the commission of each property, the expenses of each property. And so that, that software allows you to do that a lot easier than trying to manipulate a spreadsheet.
What about on the owner statement side? How what tools, what processes have you found help to streamline that? And just owner statement creation.
I can go first because that's we produce those every month. So we do, we work with software for those. We started out with an Excel file that kept breaking and had lots of errors. So at this point, we work with the two kind of bigger ones in the space, VR platform and clearing. So they are able to kind of take that data from the PMS, take that data from the bank accounts from QuickBooks and turn that into owner statements. So the big thing, and Jonathan kind of touched on this earlier, is we're not double entering anything anywhere. We're not entering things one place and then entering it another place. everything gets entered in one place and then talks to each other, so that you have kind of one source of truth. The booking data comes from the PMS and then flows through to that owner statement. Gives the owners a portal. Going back to like the tech fee, a lot of times this is, a good opportunity to introduce a tech fee when clients come on board and they haven't been using an owner portal and they've been doing owner statements manually. It's like, oh, we have this new technology, we have this new software, you can view owner statements, you don't need to bug me and wait for things. So you're able to kind of introduce that as well, giving them a login so that they're not constantly pinging you like, can I get this owner statement, especially around tax time.
Yeah, and I do think too that it seems like maybe there's a split between some folks who use those systems and others, like if you're using Track, Streamline, LiveRes, they all have owner statement generators as well. So having the ability to kind of, if you're going from those systems, having generally they have fairly decent ones, and then there's a handful of PMS systems I think that have much more limited owner statement generators that I think kind of beget more custom tools as well. So and again, all these PMSs are building this stuff as well. I feel like every month they're releasing new things to try to improve the owner statement generator.
I think
and if you are using a PMS, go ahead.
What would be nice for our industry if every PMS had the same verbiage for the actual whatever the names are, the gross bookings or the gross rents or whatever. So a lot of times we see some of the owners of the companies don't even fully understand what the PMS is, what it's actually calling it. So it comes up on the owner statements and it's just not super transparent there. So please, PMSs, I know y'all are competitors, but create a standardized vernacular,
proprietary vocabulary. Apparently,
it's honestly some of the OTAs too. Like Vrbo will call something different than Airbnb will. And I was going to say, if you are going to use your PMS, and there's certainly ones that are more robust than others when it comes to owner statements. If you're going to kind of keep everything within that PMS system, just make sure there is some kind of reconciliation method to make sure your bookings and your PMS equal your cash in your bank. Because that's really where we see the limitation with a lot of them, is that there's really no way to verify that.
Hey, Ben, I'm just seeing this question from the audience around like how long it should take to close the month. And that's always one I'm curious about. Is there anything, how would you kind of think about it? Is it 5 days at the end of the month, maybe no later than 10? Do you typically have your managers advise your owners if there's a bit of a window? Because it does seem like it varies by a company we work with.
Yeah, our typical goal is like 5 business days, 5 days after the close, 5 business days, because sometimes Saturday is the first, and we run into that issue. We try to get our owners or our clients to tell their owners payouts in the bank by the 15th. Usually, more often than not, we're beating that, and I'd rather kind of under promise and over deliver on that aspect. Biggest holdup is usually the expenses. So having some kind of expense management really does kind of speed that process up. A lot of Amazon transactions, a lot of Walmart transactions, and being able to trace those back to which property is really key to kind of getting those statements done and turned around. Because again, the revenue does come from the PMS, and usually you can close that up pretty quickly.
All right, we got a couple more minutes here. Thank you everyone for all the questions. This is great. I'm sorry that we're not able to get to it. We have a lot of questions on the back end coming in here, but maybe another one. So someone asked earlier, just to clarify, Jacobie, someone mentioned 30% net profit margin. Is that based on gross revenue or net revenue after paying homeowner commission splits? I think that's a good one to just make sure everyone really understands.
Yeah, net revenue. So after the homeowners have been paid out.
Cool. Perfect. And then yeah, how are you thinking about multiples these days? Someone asked that. Always a fun topic. It sounds like it was tailor-made for you, Jacobie.
John, you want to take this? No, I'm kidding.
I actually have no idea, Jacoby. Go for it.
Yeah, so the time period that's currently measured is your trailing 12 months. So if that was today, that would be, call it November of 2023 through October of 2024 is the time period to look at. And the multiple is applied to your adjusted EBITDA. So you would find your net income, and then you would make various acronym EBITDA adjustments, but then any other kind of add backs or deductions that would not be part of the go forward. But essentially, for companies that are between 250,000 and $1 million of trailing 12 months adjusted EBITDA, it's around a 3 to 5 multiple of that. So if you're at $500,000 of profit, around a 4 multiple, so $2 million purchase price. So essentially, you're getting paid 4 years of your profit. As you get above $1 million, there's just less companies that are at that scale. So the scarcity issue comes into play, and also like financial buyers start getting interested in deals that bigger. So between 1 and 3 million profits, we see around a 5 to 7 multiple, and then it can kind of go up from there. And structure multiples are like the sexy term to talk about, but like structure is honestly just as important, if not more important. And the cleaner, more professional your company is and looks and operates, the better structure you're going to be able to command. And that really starts with your financial hygiene.
And Jacoby, when you say structure, I assume you're referring to just maybe how that might be paid out, right? So like, is that over a lump sum, or are you having to take residual payments over a period of time? Are you tied to that? Are you with the business for another year, 2, 3? Is that kind of what you're referring, like just the construct that you would?
Yeah, exactly. Exactly. So they're not going to hand you 100% cash at close and you retire to Jamaica to sip on Mai Tais the day after closing, unfortunately, because the assets of these deals are these fickle management contracts. So typically you'll see around 50 to 75% cash at close, and the remaining paid out 1 to 2 years later, sometimes with like a performance contingency on it. But the way to like increase the amount of cash at close is like operationally being like, if you can slowly start to remove yourself from being the homeowner liaison and a little bit away from some of the ops. And then also, depending on how the company is doing, what brand, what market you're in, there's a lot of kind of intangibles that you can do to increase your terms.
Jacoby, one last question I have you seen any folks that kind of structure longer term owner agreements, 2-year, 3-year contracts, and would that impact valuation, or is that, and maybe that's, have you seen that at all, or is that not something you see?
We've seen a couple of companies, weirdly enough, in like the western part of the U.S. and even more specifically in the Pacific Northwest, that do 2-year contracts are pretty common out there. I would say it probably nominally impacts it to the positive. But the way to think about it is like, you're not going to want a homeowner on your program if a homeowner doesn't want to be on your program. So like, just even if you have them on a contract. So yeah, that's typically the way to think about
it. So the contract doesn't really.
now don't have month to month, but definitely have annual contracts that auto renew. But yeah, so at the end of the day, like practically speaking, like if a homeowner wants to leave the program, you should probably let them leave the program.
That's fair.
All right. I wish we could keep chatting about this all day, but yeah, we're up on 1 hour, which is what everyone had joined for. And yeah, for everyone joining, thank you a ton. John, Ben, Jacobie, thank you guys a ton. Yeah, maybe real quick before we sign off, we just go around, tell us, who should get in touch with you? How can they get in touch with you? And then yeah, if you guys ever want to reach out to everyone here, feel free. Jacobie, where can people find you?
Sure. Yeah, I'll start off. Yeah, obviously our website, c2gadvisors.com. Feel free to fill out the contact us form. You can email me. It's my first name, Jacobie at c2gadvisors.com. Email me anytime. You can LinkedIn message me, any of those stuff. Feel free to reach out if you have any specific questions from what we talked about. We do around 50 valuations a year, and I would say half of those are companies not looking to sell. They just want to kind of understand the forest from the trees, like where they stand in the market, and kind of what are some things they can focus on. So if you're ever looking at getting a valuation done, feel free to reach out.
Perfect. Ben?
Sure. So similar kind of as Jacobie, our website, keystonebookkeepers.com. We've got a contact form. You could book a call with us. My email is bcoons@keystonebookkeepers.com. Or you can message me on LinkedIn as well. We work with property managers, again, anyone from just starting out to, over 100 plus units, looking to grow your business, looking to kind of get your financials in line, and looking to stop putting together your your owner statements.
All right,
Yeah.
John.
Yeah, I mean, you can reach out on our website or email me directly, john@topkey.io, or on LinkedIn as well. So,
All right. Thank you, everybody. Yeah, and there were questions around Top Key and anything we didn't get to, feel free to reach out to me, Darren at topkey.io. And yeah, we'll see how we can help out. Thank you so much, everybody. Till next time. Thank you.
thanks, everybody.
Thanks, everyone.
So yeah, thank you.